And for more on today's interest rate hikes and the overall Fed policy, let's bring in now Saruhan Hatipoglu, the CEO of BERI and CGTN's Global Economics Analyst. Welcome back.
Good evening.
So President Trump already criticizing the Fed's interest rate at the top of his hour-and-a-half-long press conference to the decision to raise the short-term lending rate, basically arguing that this makes future hikes more likely. Do you have any sense that this would make any impact on the Fed's next decision, which we kind of already have a forecast on?
I don't think it does. The reason I'm saying that is because Mr. Powell is a very smart person and political person as well. He has been, Bloomberg reported this, that he's been in the Congress 48 times in his first 6 months, as opposed to 13 times by Ms. Yellen. And he's not going there to have coffee and breakfast. He's going and talking to congressmen, congresswomen, and explaining policy of Federal Reserve, because he knows that the Federal Reserve independence was granted by the Congress back in 1913. And I think he's playing a very smart political game. So I don't think he's going to be affected. And also the decision today, as well as what they said the decisions would be in the future, is a sign to me that they're going at what they know best, and that's monetary policy.
The big question for everybody after all of this talk of trade war continues to be when we will see an impact on inflation and the consequences of the tariffs and trade wars, not just on China, but on Canada, on steel and Europe and potential auto tariffs. There was this comment earlier by Jerome Powell, the tariffs might provide a basis for companies to raise prices in a world where they've been very reluctant to and unable to raise prices. So could the Fed stance make it tougher for American families to cope with tariffs?
Definitely, and here's the problem. I think Mr. Powell alluded to the intermediate goods, the impact of tariffs on intermediate goods on the business side. Right now we're talking about the 200 billion and then maybe the next 267 billion, and that's going to affect...
Don't forget the bump up at the end of the year.
Correct.
For 25% on that 200 billion.
Exactly. So that's going to affect the consumer prices. Now, this is coming at a time when we have energy prices at their highest. This is coming at a time when we're seeing wages increasing, slowly, yes, but steadily. And now you're bringing consumers into the picture. I don't think you'll ever get that bored, but if you looked at Federal Reserve's index of laundry equipment...
You underestimate me.
Index of laundry equipment was up 17% after after the washing machine ban came to place. Now, we don't feel that because I don't know.
More expensive. Most people don't buy them more than once every
you don't go there every day and buy washing machines.
Yeah.
But the impacts are there, and it's going to be more and more with the 200 billion and 267 billion earmarked.
Well, especially because those are consumer goods, right? So,
exactly.
Okay. Well, kind of broadening it out a little bit, the impact of Brexit, the impasse there, do you think that plays into the calculation for the Fed?
I think they're looking more at the trade war, and they're looking at more at the impact of their decision on the U.S. dollar, which has really, really affected emerging markets. Brexit, I think, to be honest, and I hear that from my clients too, it's been baked in. Everybody knew. And I was here a year and a half ago saying the same thing. This is not going to meet the timetable. There's a lot to do here. There's so much difference between the two sides. They're not going to do it on time. So I think the investors have it baked in. Politicians have it they were expecting this. So yeah, there's going to be a quick short-term impact, but I don't think it's going to jolt the markets.
So we're looking at a scenario under which we could get up to 3.5% on this short-term lending rate. That's still not a very high interest rate, even if it's above that, in terms of what you pay to take out a loan.
Right.
Where's the point when you think we get Americans to save more, which would help them to get through these types of ups and downs?
Yeah, with 2.4% savings rate, which is lowest in decades. In 1960s, it was 11%. Let's just compare the two. I think it's going to have an impact, yeah, and the interest rates are going to keep rising. Look, they talked about neutral federal funds rate. I'm not going to bore the audience what that is. That's an educated guess that they make. But they increased that. And the interest rates have been below inflation for 9 years when we had an economic growth going. That doesn't happen. That only happens when you have a slump. Exactly. So it's going to go up, and it's going to have an impact on the mortgages. We've already seen home sales decline rapidly. Just most recent numbers. Exactly. So when you look at all that, it is very important that consumers save money increase the savings rate, and that, by the way, has an impact on your trade deficit too. It reduces it.
That's what I was going.
Yeah. Right. Not the tax cuts that we've seen in the $1.5 trillion, but that remains to be seen because that's a long term.
Right.
Changing the savings rate, moving it outwards is a long-term goal, not a short-term.
And 3 to 4% may not be enough to really encourage people to save at that rate.
I think 3.5 or so will begin to push people because people have been moving away from banks with the low interest rates because of the QE policies. So when people see this interest rates going up steadily, I think they may actually save a little more, but not too much immediately.
I think you found a silver lining for us there. Thanks so much.